The Dhandho Investor Summary covers core ideas, principle, example, and practical applications, providing an in-depth exploration for audience in value investing strategies, low-risk, high-return investments, Dhandho investing principles. The comprehensive summary of the Dhandho Investor, the low-risk value method to high returns by Mohnish Pabrai. Introduction to Dhandho investing, a low-risk path to wealth building. When it comes to value investing strategies for beginners, or how to achieve high returns with low risk, the Dhandho Investor by Mohnish Pabrai stands out as a seminal work. Published 2007 by John Wiley & Sons Incorporates. This book introduces readers to the Gujarati concept of Dhandho, which translates to endeavors that build the wealth while minimizing risk. For those searching, what is Dhandho investing? Or how to invest like Warren Buffett, Pabrai offers a compelling framework that flips traditional investing wisdom on its head. Instead of associating high-return investment opportunities, a philosophy encapsulated in the mantra, "Heads, I win, and tails, don't lose much." Pabrai is a successful fund manager and founder of Pabrai Investment Funds, draws inspiration from legendary investors like Warren Buffett and Charlie Munger, as well as real-world entrepreneurs such as the Patels of Gujarat, Richard Branson, and Lakshmi Mittal. This summary explores the book's 17 characters, focusing on its core principles of Dhandho investing, illustrative case studies, and actionable advice for how to start value investing with minimal capital. Whether you are researching best books on value investing or how to build wealth small investments, this detailed guide will unpack the strategies that have made the Dhandho Investor a go-to resource for aspiring investors. Chapter 1. Patel Motel Dhandho, the genesis of low-risk wealth building. For those Googling how immigrants built wealth in America or successful small business investment stories, introduce the remarkable tale of the Patels, a Gujarati community that transformed the U.S. motel industry. Despite comprising than 0.2% of the U.S. population, Patels own over half of the national motels, controlling $40 billion in assets by 2007. This story is a cornerstone of Dhandho investing success stories and exemplifies how to turn small investing into big profits. The Patels arrived as refugees in the 1970s, fleeing Idi Amin's Uganda with little capital and education. Facing problem, how to start a business with no money, they capitalized on a distressed market, motels suffering from the 1973 oil embargo and recession. Papa Patel, a hypothetical archetype, bought a 20-room motel. Papa Patel, a hypothetical archetype, bought a 20-room motel to unload distressed assets. By living on-site and using family labor, he slashed operating costs, offering the lowest rates and achieving high occupancy. Pabrai calculates this yielded a 400% annual return on the $5,000 investment, with a downside limited to losing the initial stake. This Patel Motel investment strategy showcases how to minimize risk in business investments. If the motel failed, Papa Patel could fall back on minimum wage jobs, saving enough to try again. The chapter's takeaway for those searching low-risk business ideas for beginners is clear: by existing undervalued assets, leverage operational efficiencies, and bet big when the odds favor you. A blueprint repeated throughout the book. Chapter 2. Manilal Dhandho, modern application of the Patel model. Moving to a contemporary example, Chapter 2 profiles Manilal Chaudhary, a Gujarati immigrant who applied Dhandho principles in real estate investing for readers asking how to invest in motels today, or successful immigrant entrepreneur stories. Manilal's journey from minimum wage jobs to motel ownership is inspiring. Arriving in the U.S. in 1991 with no assets, he worked grueling hours, 112 weekly, at a gas station in Cherokee International. By 1998, he and his siblings pooled $60,000 to buy a house, living frugally to save more. In 2001, when the travel industry slumped after September 11th, Manilal seized a distressed asset investment opportunity, buying a Best Western motel for $4.5 million with $350,000 down, 25% stake, and partners covering the rest. Managing it himself, he boosted occupancy from under 60% to over 65% and rates from $55 to $70, generating $800,000 plus in annual cash flow by 2005. The motel's value doubled to $9 million, yielding a 48% annualized return. This how to profit from economic downturns case reinforces the Patel model. Wait for the right moment, invest in distressed assets, and maximize returns with minimal risk. Chapter 3. Virgin Dhandho, starting big with minimal capital. For those searching how Richard Branson built his empire or low-capital business startup ideas, Chapter 3 examines Virgin Atlantic's 1984 launch. Unlike the Patel's frugality, Branson's flamboyant approach still aligns with Dhandho investing techniques. With no airline experience, he identified a service gap on the London-New York route and leased a Boeing 747 for a year, risking just $2 million against his music business's $12 million earnings. By collecting ticket revenue up front and deferring costs, he minimized working capital needs. This how to start a business with little money example proves that creative low-risk investment strategies can apply to any industry. Virgin's success spawned 200-plus businesses, generating $7 billion annually by 2007, often with partners bearing the risk, e.g., Virgin Mobile with Sprint. For entrepreneurship with minimal risk seekers, Branson's lesson is replacing capital with ingenuity, exploit gaps, and structure deals to limit downside. Chapter 4. Mittal Dhandho, turning around distressed giants. Chapter 4's Lakshmi Mittal Steel Empire story appeals to those researching how to invest in distressed industries or turnaround investment strategies. Mittal, a Marwari from India, bought failing steel plants globally, starting with a Trinidad plant in 1989 for $220 million. Using family capital and operational expertise, he transformed it into a profitable entity, scaling this model to become the world's richest steel magnate by 2005. His low-risk, high-return business turnaround approach mirrors Dhandho. Buy cheap, fix inefficiencies, and reap outsized rewards. Chapter 5. The Dhandho Framework, 9 Principles for Wealth Creation. The heart of the book, Chapter 5, outlines 9 core principles of Dhandho investing, a must-read for value investing frameworks explained enthusiasts. These principles, detailed in subsequent chapters, are: Number 1. Invest in existing businesses. Avoid startups' uncertainty. Number 2. Invest in simple businesses. Understandable operations yield predictable returns. Number 3. Invest in distressed businesses in distressed industries. Buy low amid pessimism. Number 4. Invest in businesses with durable moats. Seek lasting competitive edges. Number 5. Few bets, big bets, infrequent bets. Concentrate on high-odds opportunities. Number 6. Fixate on arbitrage. Exploit pricing inefficiencies. Number 7. Margin of safety, always. Buy below intrinsic value. Number 8. Invest in low-risk, high-uncertainty businesses. Embrace uncertainty with limited downside. Number 9. Invest in copycats rather than innovators. Back proven models. These how to apply Dhandho investing principles form a cohesive strategy for building wealth through value investing. Chapter 6. Invest in existing businesses. For why invest in established companies, Pabrai argues that existing businesses offer cash flow and stability. Unlike startups, they're low-risk investment options for beginners, reducing guesswork. Chapter 7. Invest in simple businesses. Simple business investment strategies shine here. Pabrai uses Bed Bath & Beyond to illustrate how discounting future cash flows, DCF, reveals intrinsic value. For how to calculate intrinsic value of a stock, he simplifies John Burr Williams' theory. Value equals future cash flows discounted to today. Chapter 8. Invest in distressed businesses in distressed industries. Investing in distressed stocks for profit is detailed with Buffett's 1960s American Express investment during the Salad Oil crisis. Bought at $35 when intrinsic value was $60 plus, it exemplifies how to find undervalued stocks in a crisis. Chapter 9. Invest in businesses with durable moats. Durable competitive advantage in investing focuses on businesses like Geico with its cost advantage. For how to identify companies with strong moats, Pabrai cites Buffett's moat analogy. Chapter 10. Few bets, big bets, infrequent bets. How to use the Kelly formula in investing dominates this chapter. Inspired by Ed Thorpe's blackjack odds, Pabrai advocates concentrating capital on high-probability bets, like the Patel's motels. Concentrated portfolio investing tips include limiting to 5 to 10 stocks. Chapter 11. Fixate on arbitrage. Arbitrage opportunities in stock market explores low-risk profit gaps. Examples include Berkshire's stock class arbitrage and CompuLink's service arbitrage, ideal for how to profit from market inefficiencies. Chapter 12. Margin of safety, always. Margin of safety in value investing explained draws from Benjamin Graham, urging buys at a discount to intrinsic value. Buffett's Washington Post purchase at $100 million versus $400 million value is a how to ensure safe stock investments case. Chapter 13. Invest in low-risk, high-uncertainty businesses. Investing in high-uncertainty, low-risk stocks features Stewart enterprises, like funeral services, level 3 communication telecom, and frontline like oil tankers. These how to profit from volatile markets. Examples show high upside with capped downside. Chapter 14. Invest in copycats rather than innovators. Copycat business investment advantages highlights McDonald's, Microsoft, and Pabrai's funds. For why invest in proven business models? Copycats refine innovation at lower risk. Chapter 15. Abhimanyu's Dilemma, the art of selling. How to know when to sell stocks. Uses the Mahabharata's Chakriyad tale. Pabrai suggests holding for 2 to 3 years, selling when price nears intrinsic value 90 to 100%. The Universal Stainless case shows how to maximize returns on value investments, turning a $5 stock into $31.50 plus. Chapter 16. To index or not to index. Passive versus active investing. For index investing versus active investing, Pabrai contrasts broad indexes, S&P 500, with active value strategies. Joel Greenblatt's magic formula offers a best passive investing strategy for high returns, targeting cheap, good businesses. How to beat the market with minimal effort lists resources like Value Line and Guru Focus. Chapter 17. Arjuna's Focus, Lessons from a Warrior. Focus on value investing importance draws from Arjuna's archery lesson. For how to stay disciplined in stock picking, Pabrai advises fixating on a few simple businesses. He ends with giving back with wealth, citing Khalil Gibran, urging readers to improve lives beyond profit. Practical applications and tools. For how to start Dhandho investing today, Pabrai provides. Number 1. Stock screening. Magic formula, pages 172 to 174, Value Investors Club. Number 2. Research sources, Edgar, Value Line, business publications. Number 3. Portfolio size, 5 to 10 stocks, page 167. Per Kelly Formula Portfolio Management. Number 4. Timing. Buy in distress, sell at intrinsic value. Conclusion. Why the Dhandho investor matters. The Dhandho Investor is a treasure trove for best value investing books for beginners seekers. Its low-risk, high-return investment philosophy blends Buffett's wisdom with entrepreneurial grit, offering practical steps to build wealth safely. Whether you're exploring how to invest like Mohnish Pabrai or Dhandho investing real-world examples, this summary captures its essence. It's a roadmap for achieving financial independence with minimal risk, proving that wealth creation needn't be a gamble but a calculated, low-risk endeavor.